Your financial advisor may never mention this to you. Your HR representative almost certainly will not. And your tax preparer probably has not thought about it since their certification exam 20 years ago. But if you have company stock sitting inside a 401k at the employer where you worked, there is a specific and narrow and extraordinarily powerful tax provision in the Internal Revenue Code that can transform the way that stock is taxed when you leave the company or retire. It is called Net Unrealized Appreciation, or NUA. And for the right retiree, it can save between $30,000 and $100,000 in federal taxes over the course of a lifetime, legally, completely above board, with nothing exotic involved. The reason so few retirees know about it is simple. It only applies to a specific category of employees, it must be done in a specific order, and a single misstep can permanently disqualify the tax benefit. Most retirees roll their 401k into an IRA the moment they leave the company because that is the default advice they receive. And that single action eliminates the NUA opportunity forever. If you worked for a publicly traded company that offered stock as a match or an investment option, and you have meaningful shares of that company stock in your 401k today, you need to understand this before you initiate a single rollover transaction. Because once the rollover happens, the NUA benefit is gone and cannot be recovered. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. Now, let us carefully walk through the mechanics of an NUA, who qualifies, what the pitfalls are, and exactly how to execute it correctly. Net unrealized appreciation is the difference between the cost basis of employer stock in your 401k and the current market value of that stock. For example, suppose you have worked at a large corporation for 30 years, and over that time, through employer matching contributions and your own purchases within the plan, you accumulated shares of company stock at an average cost of $20 a share. Those shares are now worth $90 a share. You hold 10,000 shares. The total market value is $900,000. The cost basis is $200,000. The net unrealized appreciation is $700,000. Under normal rules, if you roll your entire 401k to an IRA, every dollar that ever comes out of that IRA is taxed as ordinary income at your marginal federal rate. That $900,000 of company stock, once rolled into an IRA, will be taxed at your ordinary income rate when withdrawn, potentially over many years. At a blended 22 to 24% federal bracket plus state tax, the total lifetime tax on that stock value could easily exceed $200,000. A substantial portion of your life's accumulated work wealth disappears to ordinary income tax. NUA changes this dramatically under the NUA provisions in Internal Revenue Code. Section 402(e), 4b, you can take an in-kind distribution of the employer stock directly from your 401k to a regular taxable brokerage account, rather than rolling it into an IRA. When you do this, you pay ordinary income tax on the cost basis only, not on the full market value. The appreciation portion, the NUA itself, is instead subject to long-term capital gains tax rates when you eventually sell the shares. Long-term capital gains rates are substantially lower than ordinary income rates. For most retirees, long-term capital gains are taxed at 0, 15, or 20% federally, compared to 22, 24, 32, or higher ordinary income brackets. Let me do the numbers on that same example. Shares worth $900,000, cost basis $200,000, NUA of $700,000. You take an in-kind distribution of the stock to a taxable brokerage account, triggering ordinary income tax on the $200,000 of basis. At a 22% federal bracket, that is $44,000 in ordinary income tax in the year of distribution. The $700,000 of NUA does not trigger any tax until you sell the shares. When you do sell, the gain is taxed at long-term capital gains rates, regardless of how long you actually hold the shares after distribution. At 15% federal long-term capital gains rate, $700,000 produces a federal capital gains tax of $105,000. Add in the state tax impact, which varies, and your total federal and state tax on the full $900,000 is somewhere around $170,000 to $190,000. Now, compared to the rollover path, the same $900,000 rolled into an IRA and withdrawn over 15 years in retirement at a blended 22% federal bracket plus typical state tax of 5% would produce total taxes approaching $243,000. The NUA approach saves roughly $50,000 to $70,000 on this single block of stock, sometimes more depending on specific bracket positioning and state of residence. For larger blocks of highly appreciated employer stock, the savings can exceed $100,000. That is the headline benefit. Now here are the strict qualifying requirements, because this is where most people accidentally disqualify themselves. Requirement 1. The employer stock must be distributed as part of a lump sum distribution, which means the entire 401k balance at that employer must be distributed within a single calendar year. You cannot leave some in the 401k and take some out. You cannot spread distributions across multiple years. The full balance must come out as part of a coordinated distribution within one tax year. Requirement 2, the lump sum distribution must occur after a triggering event. There are 4 qualifying triggering events. Separation from service, meaning you leave the employer, which for most retirees is retirement, reaching age 59 and a half. Death, which triggers NUA eligibility for beneficiaries, or disability as defined by the plan. For most retirees, the triggering event is separation from service, which happens automatically when you retire. Requirement 3, the stock must be distributed in kind, meaning the actual shares are transferred to a taxable brokerage account. You cannot sell the stock inside the 401k and receive cash. You cannot reinvest the proceeds inside the plan. The shares physically move from the plan's custodian to your personal brokerage account, usually through a transfer arrangement your plan administrator coordinates. Requirement 4. The non-stock portion of your 401k can be handled separately. You can roll the non-stock portion, typically mutual funds, target date funds, bonds, and other investments, into a traditional IRA in the same calendar year, and that rollover is tax-free. So, the complete sequence typically looks like this. In a single coordinated event, the stock goes in kind to a taxable brokerage account, and the remaining non-stock assets roll into a traditional IRA. Both transactions happen in the same tax year. Requirement 5. You must recognize ordinary income on the cost basis of the stock in the year of distribution. The plan administrator will issue a Form 1099-R showing the full market value of the stock distributed, but there is typically a separate line or code indicating the NUA portion, which is excluded from ordinary income in that year. Your tax preparer must handle this correctly on your 1040. If they treat the full amount as ordinary income, you have essentially given away the benefit. Walk them through the distribution in advance and confirm they understand NUA reporting. Richard, a retired senior engineer from Michigan who spent 34 years at an automotive manufacturer, executed his NUA distribution at age 65. He had accumulated 42,000 shares of company stock with an average cost basis of $14 per share. The stock was trading at $41 when he retired. Total market value was $1,720,000, cost basis was $588,000, and the NUA was $1,132,000. He took the stock in kind to a taxable brokerage account and paid ordinary income tax on the $588,000 cost basis, which, with careful bracket management and a large charitable contribution in the same year, came out to an effective tax rate of about 19%, or $112,000 in federal tax. He then held the stock for 2 years, during which time it continued to appreciate and began selling shares gradually. He spread the sales across several years at long-term capital. Gains rates, paying 15% on most of the NUA. His total federal tax on the entire $1,720,000 position came out to approximately $275,000. The comparable rollover and distribute over time approach would have cost him closer to $400,000. Net savings, over $125,000. Now the traps. This strategy is unforgiving, and I want to walk you through each common mistake. Trap 1. Rolling over before you understand NUA. Once the stock moves into an IRA, the NUA benefit is permanently lost. The cost basis information is not maintained in the same way inside an IRA. Every dollar that later comes out of the IRA is treated as ordinary income. There is no path to recover NUA after a rollover. If you have employer stock and you are retiring, do not initiate any rollover until you have evaluated whether NUA is right for your situation. Trap 2. Waiting too long between the triggering event and the lump sum distribution. The entire 401k balance must come out in the same calendar year as a single event. If you take partial withdrawals after retirement but before the full distribution, you may accidentally invalidate the lump sum requirement. Coordinate the distribution carefully with your plan administrator. Trap 3. Forgetting that the cost basis is taxed in the year of distribution. If you have a large position, the cost basis itself might be substantial, and paying ordinary income tax on a several $100,000 cost basis in a single year can push you into higher brackets, trigger IRMA surcharges, and create a substantial one-year tax event. Run projections in advance. Some retirees plan their NUA distribution in a year they expect to have lower other income, such as the first year of retirement before Social Security and pension payments ramp up. Trap 4. Holding the stock too long without diversification. NUA is powerful, but it concentrates your wealth in a single stock. If that company has a bad decade, you can watch the tax-advantaged position lose significant value. Most prudent NUA practitioners develop a sell-down plan that diversifies the holding over the first several years while capturing long-term capital gains treatment. Do not let the tax tail wag the investment dog. Trap 5. Not considering the 10% early withdrawal penalty. If you are under 59.5 when you take the NUA distribution, the cost basis portion may be subject to a 10% early withdrawal penalty on top of ordinary income tax. This does not apply if separation from service occurred in or after the year you turned 55, which is the qualified age 55 separation rule for 401k plans. The interaction between NUA and early retirement distributions can be complex, and it is worth consulting with a qualified tax professional before proceeding. Trap 6. Missing state tax considerations. Some states tax long-term capital gains the same as ordinary income. Others offer preferential treatment. The total NUA benefit depends on both federal and state rate structures. A retiree in a state with favorable capital gains treatment captures significantly more NUA benefit than one in a state that taxes gains as ordinary income. Beatrice and her husband Thomas, a retired chemical plant supervisor from Louisiana, ran into the state tax trap without realizing it. They assumed the entire NUA benefit was captured at the federal level, and they did not fully account for Louisiana's treatment of investment income. Their total savings was still substantial, approximately $47,000, but it was noticeably less than the federal-only projection suggested. The lesson here: run the numbers with both federal and state implications included, and choose the year of distribution carefully if your state offers any preferential treatment for certain ages or income levels. Now let me walk through the decision framework for whether NUA is right for you. Factor 1. The ratio of NUA to cost basis matters enormously. If the appreciation is large relative to the basis, NUA produces substantial savings. If the appreciation is small, the savings are modest. A good rule of thumb is that NUA tends to be most valuable when the appreciation exceeds 50% of the total market value. Below that, the numbers start to get close to neutral. Factor 2. Your expected ordinary income tax bracket matters. If you are likely to be in a low bracket throughout retirement because of modest income and good tax planning, the NUA benefit shrinks because ordinary IRA distributions might not cost much more than long-term capital gains treatment. If you are likely to be in higher brackets because of substantial Social Security, pensions, RMDs, and other income, the NUA benefit is larger. Factor 3. Your planned holding period matters. NUA is more valuable if you plan to hold and slowly sell the shares over years, spreading the capital gains recognition. If you plan to sell the entire position immediately, the benefit is still real, but not maximally exploited. Factor 4. The size of the stock position relative to your total portfolio matters. A $10,000 NUA position is not worth the complexity. A $500,000 NUA position absolutely is. Factor 5. Your estate planning intentions matter. NUA at death receives a step-up in basis for the NUA portion under current rules, meaning heirs inherit the stock at the date of death value with a fresh basis, potentially eliminating the NUA portion of the tax entirely. This makes NUA particularly powerful for retirees who do not plan to sell the stock during their lifetime. Combined with estate planning, NUA can be one of the most tax-efficient multi-generational wealth transfer tools available. The mechanics of execution are straightforward but require coordination. Step 1. Talk to your plan administrator and confirm the plan allows in-kind distributions of employer stock. Most large plans do. Step 2. Open a taxable brokerage account at a discount broker or a full-service firm ready to receive the shares. Step 3. Set up a traditional IRA at the same broker, or a different one, ready to receive the non-stock portion of the 401k. Step 4. Coordinate the simultaneous transfer of the stock in kind to the brokerage account and the non-stock assets via direct rollover to the IRA, both within the same calendar year. Step 5. Work with your tax preparer to correctly report the distribution on your return, showing the cost basis as ordinary income, and clearly identifying the NUA portion on the appropriate line of Form 1040 and any supporting schedules. Step 6. Track the cost basis of the stock in your brokerage account for future sales, because this basis becomes your reference point for long-term capital gains calculations as you sell portions of the position over time. The final consideration: if you hold employer stock inside a 401k and the stock has not appreciated significantly, NUA may not be the right move. Simply rolling the entire balance into a traditional IRA gives you continued tax deferral and the flexibility to rebalance inside the IRA without triggering any tax. Evaluate, honestly. If you're sitting on meaningful employer stock inside your 401k and you are within 3 years of retirement or separation, schedule a focused planning meeting with a qualified advisor specifically to evaluate NUA. Do not roll your 401k until that analysis is complete. One conversation could preserve tens of thousands of dollars of your lifetime earnings. One final reminder. The NUA benefit is fundamentally a tax arbitrage between ordinary income rates and long-term capital gains rates. If tax law were to equalize those rates in the future, the NUA benefit would shrink or disappear. Current law gives us a favorable rate differential, and the strategy captures real value under current rates. Like most tax planning, timing matters, and there is no guarantee that the current structure will remain indefinitely. If you are sitting on significant employer stock and are approaching retirement, the most protective move is to evaluate and execute the NUA strategy, while the current rates apply, rather than waiting indefinitely. The window is open today. Subscribe to the channel if you want to be alerted when next week's video drops, which is going to be a detailed walkthrough of catch-up contribution rules for people between 50 and 59, a space where the rules shifted significantly under Secure 2.0. Share this video with anyone in your life who is retiring from a publicly traded employer, because the odds are good that their advisor is not specifically experienced with NUA, and the cost of that blind spot can be enormous. Thank you for watching, take good care, and I will see you in the next video.